What's the difference between AUC and AUM? Let's learn about this in this video. I'm a learning partner, Sushila Hariharan, and if you're interested in a career in custody operations, trade life cycle, hedge funds, and global financial markets, do subscribe to my YouTube channel where we provide content-centric, research-focused videos on these topics. AUM is a topic that is very well known to many of the executives working in investment banks and hedge funds. This is assets under management, which refers to the total value of the investment portfolio of the fund. On the other hand, we're going to talk in this video about AUC, that's assets under custody. Now, what is custody? To understand custody, we have to understand the role of a custodian. The global financial markets are largely divided into the buy side and the sell side. The sell side refers to the activities of prime brokers, market makers, dealers, investment banks, etc., who are selling their services, their knowledge services, their pricing services, sometimes even their software technology to the buy side, comprising of different types of pooled funds. So the sell side comprises investment banks, dealers, brokers, and market makers. The buy side comprises all the different types of hedge funds, mutual funds, insurance companies, private equity funds, etc. So they are buying the services of the sell side. Over here, we must remember that the pooled fund concept works for the buy side entities, that is, hedge funds, mutual funds, pension funds, insurance companies, etc. All of them collect capital, right, from different investors in varying degrees depending on whether they are a hedge fund or a mutual fund, and on that basis they create a pool of capital, and this pool of capital is collectively invested in the markets. Such kind of pooled funds, also called as collective investment vehicles, are important in any market mechanism because they trade in large volumes and are thus the makers and shakers of the markets. So over here, it's important to realize that these pooled fund concepts, because these pooled funds, because they collect capital from different types of investors, and these investors could be retail, as in the case of mutual funds, or they could be accredited investors, as in the case of hedge funds or private equity funds. The pooled funds are then invested. Now, this invested capital at the market valuation forms what is called as AUM, or assets under management. Now, because they are literally trillion-dollar businesses, okay, if you look at some of the largest hedge funds in the world, if you look at some of the largest pension funds like Vanguard, they manage more than billions of dollars of money, of investors' money, which is invested in different asset classes, whether it's in the money markets, whether it's in the equity markets, whether it's in the bond markets, and so on. So over here, it's important that when they are doing the buying and the selling, and when they are managing the assets, they will not be responsible for movement of the assets. This activity, with best practices from across the globe and as per SEC regulation, is managed by custodians. The custodian is a caretaker, is a gatekeeper, is a safekeeper of the assets under management of the pooled fund. So if there is a hedge fund and the hedge fund is managing $5 billion worth of equities, then every time the hedge fund buys or sells these equities, it must inform the custodian. The custodian is thus the manager, is not the manager of the fund, but is the manager of the custody operations of the fund. They are only responsible for the possession of the securities. The owner of the securities continues to be the fund manager, and the fund manager then will give instructions. I mean, not really the fund manager, but down the line, the executives will give the instructions to the custodian to deliver the securities if the fund has sold the securities, or to pay for cash in case they have bought the securities. So such custodians literally handle trillions of dollars worth of securities of the different funds. Can one asset management company have many custodians? Yes. Can one custodian have many asset management companies as clients? Yes. In fact, some of the largest assets under client custody include names like Northern Trust, State Street, etc., which handle more than 7 or 8 trillion dollars worth of assets of their clients. And these are global custodians, literally meaning that they handle the clients' assets in different parts of the world. So, three things you must remember. Can a custodian trade on their own account? No, they cannot. They only accept instructions and they can deliver these security as per the instructions. Second, are they the legal owners of the securities? No, they are only in possession of the securities. They do not own the securities. Because of which the first step obviously automatically is answered, that they can work only under instructions from the asset management company. So assets under custody, AUC, is very different, very distinct from assets under management. The third point to remember about assets under custody is they are very much involved in also the processing of corporate actions for the fund. Okay, so if the fund is holding a stock and in that stock the company, the issuer of the security, has announced a corporate action, then it's important that the study of that particular stock will result into processing of the stock split or a corporate dividend or whatever is the announcement made by the issuer with respect to processing of that particular corporate action. So all in all, the custodian has to be the safekeeper, the literally like the guardian of the assets of the fund management company without having any ownership of the fund. Thank you so much for watching in.